Another very quick concept we want to discuss, and that is called provision for unrealized profit. Provision for unrealized profit, which is very commonly called as PUP. Okay, and we will be calling it throughout PUP. Now, what happens that during consolidation process, you have this entity, which is entity A, and there is an entity B. So entity A purchased some goods for 800, let's suppose, and they sold these goods to entity B for 1000, and they record a profit of 200 from this transaction. For entity A, this transaction is completed. They have sold the goods to B, and they made a profit of 200. So what they do that within their individual financial statement, they will write down revenue 1000, and they will write down cost of sale as 800, and they are actually recording a gross profit of 200 in their financial statements, A, because A considers that this transaction is completed. We sold the goods, we got the money. Entity B, what they will do, they will also say that this is my purchases. They purchase the goods for 1000, and they will record cost, as 1000, because they don't know that goods were purchased for 800 or whatever. They will see their invoice value, and they would record this purchase price as 1000. Now, both are correct in individual financial statements. But then what happens that when you make the group financial statements, and we know that both of these entities, they lie in the same group, they are under the same roof, they are within the same group. For the group, that sale has not taken place, because group only record in a group financial statements, we record transactions which are external group to the group. Now, this type of transaction is called intra-group transaction. We call them intra-group transactions. And intra-group transactions must be eliminated, because intra-group transactions are not, they are within the group. We don't realize them, we don't record them. Now, what happens that if B sells these goods outside, because B purchased goods, maybe B is planning to sell them for, I don't know, 1300, making a profit of 300. If the goods, they go out of B, which means that they leave the group. If these goods are not sold, they are still within the group. But if these goods are sold, then we can consider that these groups have left the group. As long as they are within the group, you cannot recognize, we call it unrealized profit. There is an unrealized profit. For the group, this profit of 200 is unrealized. We call it unrealized profit, because this is a profit which A has realized and A has rightfully realized, but group cannot realize this profit. Let's suppose that all of the goods are here. Supposing that nothing was sold out. Nothing was sold out. All of the goods are within the group. If this is a situation, what we need to do, we need to make adjustment, because what has happened, there are two things which have happened and which actually are, how to say, not, because what has happened that A recorded profit of 200, which is for the group, this profit does not exist. B recorded the inventory for 1000. B recorded the inventory for 1000. Consolidation, like we say that the inventory should be recorded in the group consolidated financial statements at the cost to the group. Now, if you ask B, what is the cost of inventory? He would say 1000, and he has that document. But this 1000 is not cost to the group. The cost to the group was 800. So we record the inventory. If there is any inventory which is within the group as a result of intra-group transaction, that inventory must be recorded at the cost to the group. The cost to the group is 800. So it means that B is overstating inventory, and A actually is overstating the profit. So there is, for the group, actually A is not overstating, but for the group purpose, profit is overstated by 200 and inventory is overstated by 200. Because in the group books, B says I've got inventory for 1000. Whereas the cost to the group for this inventory was only 800. So what we usually do in this situation, now we need to actually, we need to make an adjustment to this transaction. We need to make an adjustment. We need to make a double entry, and that double entry would be, let me pick another color if I can. That double entry should be debit group retained earnings. So the group profit will be reduced by 200. You know that retained earnings and profits are credit. So I'm debiting group retained earning, and I should say debit group inventory. Debit group inventory by 200. So this is one double entry which is needed for unrealized profit. We call it PUP, unrealized profit. And that PUP, unrealized profit, you should reduce it from the group retained earning, and you should reduce it from the group inventory. Let's suppose the question tells us that B sold 50% of the goods. 50% of the goods. 50% of the goods were sold by B, which means half of the goods have left the group. So what is inside the inventory? Then we will consider that in this case, B purchased goods for 1000. In this 1000, 200 was profit. Now half of the goods are sold. The remaining goods are only 500, and within 500 goods, the profit was only 100. So then in that case, you should actually say not 200, your group unrealized profit will be recorded as 100. So you need to see that what percentage of the intra-group sales inventory is within the group. So how do we do that? First, we find out how much was the total profit on that particular transaction or intra-group sales. So we find out that the total profit was, let me just give me a minute, please. So a typical, what type of requirement they will give you. They will tell you that the parent sold goods to subsidiary for, let's call it 3 million, or okay, let's not make it 3 million, make it a simple number, for 1 million. At 20% markup, 20% markup. And then they will also tell you that half of the goods were still in subsidiaries inventory at year end. This is a very typical scenario. Every question of consolidation, you will get this intra-group sale. Literally every question. So don't expect that a question comes and you don't see this type of transaction. First thing you need to calculate, you calculate how much was the total profit on the transaction. So the total profit on this particular transaction would be 1 million. And because I'm saying it is 20% markup, I would say 20 divided by 120. Now, in some cases, they will give you margin as well, but in most cases, they will give you markup, because markup is slightly tricky. So 20 divided by 120 divided by 120, I can see that there is a total profit of 166,666. So this is the total profit on this transaction. But half of the goods were in inventory, which means this is my total profit, but my PUP, unrealized profit, half of that would be 166,666 divided by 2. So you divide it by 2 and you get, 83,000. and 333. This is your unrealized profit. This number must be subtracted from the group inventory, and it also must be subtracted from the group retained earning. Now, unrealized profit in this intra-group transaction, there are different situations. There is just one thing you need to remember, that within the group, there is a parent and there is a subsidiary. It is possible that parent is selling goods to the subsidiary, or the subsidiary is selling goods to the parent. And these are two different situations. I mean, these are intra-group transactions. But ultimately, they are going to impact on NCI. So remember that. Let us suppose, I'm going to do it with the help. I mean, we are going to apply this in the question as well, so it will become more clear. But just for initial understanding, let's suppose that if the profit of the parent is, let's call it 1 million. If parent had a profit of 1 million, subsidiary has a profit of 600,000. And let's suppose that there is no unrealized profit. Imagine there is no unrealized profit, there is no intra-group transaction, and we know that there is NCI of 20%. So NCI will walk in, NCI will say, I got 20% in S, so give me 20% of 600,000. So he's expecting 20,000 of 20% of 600,000, which makes it 120K. This is the profit share of NCI in the absence of unrealized profit. But imagine that S has sold goods to B, subsidiary has sold goods to the parent. Now NCI walks in, NCI says, there's a 600,000 profit, give me my 20%. I say, wait a minute, this 600,000 profit, it includes 83,000, this one. It includes 83,333, okay? This is unrealized. Let's subtract it. Whatever is remaining is, let's call it 517,000 for the sake of simplicity. And I will give you 517 into 20%. So it means that this unrealized profit, if the subsidiary, now rule is, remember, if the subsidiary sells goods to the parent, it means that the unrealized profit is within subsidiary's profit, and it must be subtracted. Before you distribute the shares. So you subtract this amount and you say that the realized profit is 517, and therefore NCI share would be 20% of not 600K, but 20% of 570K. This is when subsidiary is selling the goods. Now imagine that if subsidiary is not selling the goods, if the transaction had occurred like this, that the parent is selling the goods, parent sold goods to the subsidiary. So in that case, the unrealized profit is actually here, not in the subsidiary books, it is actually here. NCI comes in and says, I need my 20%, then you must take 20% of 600K, because unrealized profit lies in the parent, and NCI is not in the parent, NCI is actually in the subsidiary. So in case the parent is selling goods, so you subtract or adjust the parent's profit, and NCI will not be impacted. Are we clear on this thing? To some extent.